Welcome to Investing Lighthouse, where we explore the world of investing in the stock market. On this channel, we'll explore what stocks are, how the stock market works, and how to make informed investment decisions to maximize your returns. Whether you're a seasoned investor or just starting out, you'll find plenty of valuable insights and practical tips to help you succeed in the stock market. So, join me on this exciting journey as we demystify the thrilling world of investing and help you take your financial future into your own hands. Before anything else, we have to start with the most basic question beginner investors most often ask. What are stocks? Put simply, a stock represents a share of ownership in a company. When you buy a stock, you become a part owner of that company and have a claim on its assets and earnings. For example, if a company has 1,000 shares outstanding and you own 100 shares, you own 10% of that company. As the value of the company increases, the value of your shares also increases. There are two main types of stocks: common stocks and preferred stocks. Common stocks are, of course, the most common type and come with voting rights that allow you to participate in the company's decision-making processes, such as electing board members. Preferred stocks, on the other hand, generally don't come with voting rights, but do have a priority when it comes to receiving dividends. Dividends, in this context, refer to a portion of a company's profits that are distributed to its shareholders and are typically paid out on a regular basis, such as quarterly or annually, and the amount paid per share is determined by the company's board of directors. Here's an example of dividends. If you own 1,000 shares of a company and the company decides to pay a dividend of $1 per share, you would receive $1,000 in total dividends. Now, while this is just a brief introduction to the world of stocks, understanding the basics is crucial for any investor. By now, you might be wondering, why would companies sell stocks? Companies may choose to sell stocks for a simple reason: to raise funds. Selling shares in the stock market enables companies to generate significant amounts of capital without any additional effort or production. In the modern stock market, a company's value is often based on its potential future earnings. This means that even relatively small companies have the potential to raise millions or even billions of dollars if investors believe they will be successful in the future. When a company decides to sell shares, they need a platform in doing so. This is where the stock market comes in, providing a centralized marketplace for companies to sell their shares to interested investors. When companies want to list their shares and make them available to the public, they typically do so through an initial public offering, most commonly referred to as IPO. On a stock exchange, this changes the company's status from a privately held business to a publicly traded one, giving investors the opportunity to buy and sell shares. IPOs can serve different purposes for companies, such as allowing founders to cash out their stake or raising funds for the company's operations. Once a company's shares are listed on exchange, the public can trade them. Now, prices of a company's share can be influenced by public opinion, but they are primarily driven by the company's earnings and operations, which can be measured using various metrics such as the price-to-earnings ratio, or PE for short, the price-to-sales ratio, and the price-to-book value ratio. It's common for casual investors to feel intimidated by these metrics and trends. But fear not, understanding the stock market doesn't have to be complicated. The next important thing to note is understanding the volatility of stock prices is crucial in investing. The stock market is a dynamic and ever-changing entity. influenced by the opinions and actions of countless investors and traders. Essentially, a stock's price is determined by the net result of all the buy and sell orders placed by the investors at any given moment. Now, when more people want to buy a stock, the price increases, while the opposite is true when more people want to sell. It's a simple concept, really not too different from buying and selling an item on Craigslist or Amazon. Think of it this way: if you posted an item for sale and suddenly received dozens of cash offers, you'd naturally consider raising the price until it reached a level where only the most eager buyer remained, because this could indicate that maybe you've priced your item too low. Similarly, if there were no takers, you'd likely lower the price until someone bid into the updated offer. In the stock market, this fluctuation is driven by millions of transactions happening at lightning-fast speeds. It's all about supply and demand, really. To understand how supply and demand works in the stock market, we have to see the stock market as a marketplace, where stocks are bought and sold, and each transaction involves both a buyer and a seller. If there are more buyers than sellers, the price of the stock goes up, and vice versa. Traders often refer to the bid-ask spread, which is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. Understanding the basics of supply and demand is crucial for any investor, as it determines the price of the stock. But simply, the more people that want to buy a stock, the higher the price will go. In the early days of stock markets, buyers and sellers would physically gather on a trading floor and engage in an open outcry, trading to buy and sell stocks. However, with the advent of modern technology, much of the trading is now done electronically by trading systems. These systems match buyers and sellers automatically, allowing for a much faster transaction and more efficient market. This also means that the market can move at a breakneck pace that can be overwhelming for casual observers. Perhaps by now you're thinking, I don't have the time or knowledge to invest, and why bother when I can earn a modest 2 to 3% interest rate by simply keeping my money in the bank? Well, it's a fair point. But consider this: if you invest wisely, you have the potential to make a lot more money. Take Apple, for instance. If you had invested just $1,000 in Apple back in 1985, you'd be sitting on a whopping $2.2 million today. Of course, that kind of return requires patience and a long-term investment strategy. However, many companies can provide substantial annual returns ranging from 30 to 70%, which can build significant wealth over time. The bottom line is that if you can earn more than a 3% return on your investment, you're doing better than simply leaving your money in the bank. Now that we've covered the basics of the stock market, it's time to talk about how you can get involved. To start, you'll need a trading account with a brokerage firm. This can be a traditional provider like E-Trade or one of the newer nearly commission-free services like Robinhood. With a nearly commission-free service, you won't have to worry about paying fees for every trade you make. Once you have an account, the next step is deciding which company's stocks to buy, and this can be a challenge. It's important to research each company thoroughly to understand how they generate revenue, assess their financial stability, and evaluate their growth potential. You should also take a look at what financial experts are saying about the company before making any investment decisions. Keep in mind that stocks range in price from a few cents to several $1,000s, and you'll need to have a certain amount of money to invest in each one. It's important to remember that when you buy a stock, you're purchasing the entire share, not just a fraction of it. While stocks like Apple may require an investment of hundreds of dollars, there are plenty of other high-quality, low-cost options available to start with. However, it's crucial to keep in mind that there is always some level of risk involved in stock market investing. So, it's important to only invest money that you can afford to lose or that you won't need in the near future. To wrap things up, we have provided you with a broad overview of the stock market and how to get started with investing. However, we only scratched the surface, and there's a lot more to learn if you want to become a savvy investor. We didn't delve into the nitty-gritty or technical analysis, jargon, or more advanced trading methods like margin trading. But don't be discouraged by the complexity of it all. The best way to learn is by getting on with it. Take a small amount of money that you can afford to lose, do your research, and start investing wisely. Remember, the stock market can be unpredictable, and it's important to only invest what you're comfortable with. So get your feet wet, learn from your mistakes, and who knows, you may just end up making a fortune. We hope you found the information helpful and informative. If you have any questions or comments about the topic we discussed, please leave them in the comments section below. We always love to hear from our viewers, and we appreciate your feedback. If you've enjoyed the video and found it helpful, please hit the thumbs up button, subscribe, and hit the notification bell so you never miss out on more financial tips and insights. Thanks again for watching, and we'll see you in the next video.